Hey everyone, welcome. Today we're diving into a tool that's going to help you bring some real clarity to the chaos of financial charts. We're talking about trend channels. Okay, let me ask you something. Do you ever just stare at a price chart and it looks like a random, jagged mess? Yeah, you are definitely not alone. It can feel totally impossible to figure out where the price is headed next. But what if there was a way to see the actual road the price is traveling on? A way to map out its potential path, making those ups and downs look a lot less random and a little more predictable? Well, that's the whole idea behind trend channels. All right, first things first, let's be super clear about the kind of channel we're discussing. And trust me, while it's not on your TV, it can be every bit as excited. Yeah, we're not talking about something you find with your remote. These are price channels, and honestly, they can be just as compelling as a big game because they help you read the market's story. So, what is a trend channel officially? Well, it's a really fundamental tool in technical analysis. You basically just take a trend line and then draw a parallel line to it, which creates a channel that contains the price action. The whole point is to identify potential zones where you might consider buying or selling. To really get this, we need to break a channel down into its two core parts, and don't worry, it's actually really simple. First up, we've got the lower trend line. Think of this as the channel's floor. This is a potential support level. It's an area where buyers have historically stepped in, thinking the price is a good value, and that pressure pushes it back up. And on the flip side, you've got the upper trend line, which acts as the ceiling. This is a potential resistance level, where sellers tend to take profits or bet on a price drop, which in turn pushes it back down. So when you put that floor and that ceiling together, you get this clear pathway for the price. As the trend continues, you'll often see the price just bounce between these two parallel lines. It's pretty cool to watch. Okay, so now that we know what they're made of, let's look at the different kinds you're going to see out in the wild, and, most importantly, how you can draw them for yourself. There are really three main flavors. You have an ascending or up channel, where the price is making higher highs and higher lows. Then there's a descending or down channel with lower highs and lower lows. And finally, a horizontal channel, which is when the price is just moving sideways in a range. So, how do you actually draw one? Well, for an ascending channel, it's a simple three-step process. Step 1, you draw a trend line that connects at least two recent lows. Step 2, just copy that line. And for step 3, move that copied line up until it touches a recent peak. And just like that, you've got a channel. The same logic applies, just in reverse, for a down channel. And once you start looking at a real chart, you can start to see these patterns just emerge. The up channels, the down channels, and the sideways channels. Once you know what you're looking for, they become so much easier to spot. This is all great, but let's get to the real so what question. How can you actually use this information? Let's talk about trading within the channel. So the crucial point is this. The two lines of the channel give you potential action zones. The lower trend line, that support level, is generally considered a buying area. And conversely, the upper trend line, or resistance level, is seen as a selling area. It really boils down to this simple idea. The strategy is to consider buying when the price comes down to test the bottom of the channel, and consider selling when it rises to test the top. It just provides a framework for your decisions. Now, before you rush off to find the perfect channel, we really need a quick reality check. The market is rarely as neat and tidy as what you see in a textbook. You've got to remember a few critical rules. First, the lines must be roughly parallel. If they're converging, you're probably looking at a different pattern, maybe a triangle. But most importantly, and I mean this, never force a channel onto a chart. If it isn't a clean fit, don't try to make the market fit your drawing. A huge mistake traders make is getting fixated on finding these textbook perfect channels. And when they do that, they often miss other valuable information the market is giving them, all because they're hunting for an ideal that rarely exists. There's a great way to think about this. Hunting for the perfect channel is like searching for the perfect person. It might exist, but it's incredibly rare. The real world and the market are messy. So after all of this, you might be asking yourself, are trend channels some kind of magic crystal ball that predicts the future? Absolutely not, but what they are is an incredibly powerful tool. They don't give you guarantees, but they do give you a framework for understanding the market's potential direction and its likely boundaries. They add structure to the chaos. So now you have a new lens to view the market. The next time you look at a chart, don't just see lines, look for the channels. And ask yourself, what other patterns might be hiding in plain sight. Thanks for tuning in.